Thank you very much for joining me, Fiona Sincota, here at StoneX. And today I have the pleasure of speaking with Kathryn Rooney Vera, who is the Chief Market Strategist at StoneX. Hello, Kathryn, and thank you very much for joining us today.
My pleasure, Fiona.
So we're going to get straight in here and have a look at your global macro outlook for 2025. Obviously, it's been quite a volatile and uncertain start to the year, and it feels like there are a lot of factors that are going to be at play, particularly with the new Trump administration and with the Fed weighing up the possibility of rate cuts across the year or not. How do you see the Trump administration's fiscal policies interacting with the Fed's approach to managing growth and inflation?
Well, Fiona, you're right. Has been volatile and will probably continue to be so. I think that we're coming into this new administration with an economy that's already growing pretty robustly. In fact, the U.S. economy is growing above potential, and this is the fourth consecutive year of economic growth above potential. We have a positive output gap, which is inherently inflationary. And so when you consider a Trump administration that is pro-growth, in the sense that we are expecting and effectively already have seen deregulation, we are expecting a permanency of the Trump tax cuts and the possibility of a reduction in corporate tax cuts. All of those things are what we call pro-cyclical policies. So when you have an economy that's already growing pretty robustly and you turbocharge it with additional impetus for growth, then I do think you have the potential for sticky inflation at a minimum, and if not, a potential reacceleration in inflation. And that puts the Fed in a tough spot.
Yeah, completely. And that's sort of what we've been starting to see. We've seen, just as we're sort of heading into 2025, is that idea that inflation has just been ticking up that little bit more, which is going to be making the Fed feel a little bit uncomfortable, I guess, with the expectations of those potentially inflationary policies from Trump. So, I mean, and how do you see that impacting market volatility and particularly the US dollar?
Yeah, you're right. So the Fed probably is on hold for the foreseeable future. And what we have seen is inflation expectations moving to the upside. So yes, in the past couple of months, we have seen inflation expectations move higher. Of course, President Trump just assumed office a few weeks ago. It's hard to believe, but that's the situation. And I think that a lot of these policies are still in the works. So we don't have tax cuts quite yet. We actually don't even really have tariffs yet. There's been the threat of tariffs, but that has been a means to an end to get some sort of concessions, which have effectively been achieved. So I think the Fed is in a wait and see mode. And I really strongly suspect that they will hold rates for the foreseeable future, with the risk that if things get out of hand, it's not my base case scenario, but if core PCE, which is the measure that the Fed uses to target 2% inflation, moves markedly higher, that the Fed could find itself in a situation where it needs to consider resuming rate hikes. Forget about rate cuts.
Yeah, I mean, that's a completely different situation to where we are, even where we were, even sort of 7 or 8 months ago, where there was this real sense of, how many times was the Fed going to cut and how low would it go? And suddenly we're in 2025 and there is that sense of, yeah, there could actually be a scenario where we don't see any rate cuts this year and we do see a potential rate hike. But as you said, again, not the base case scenario there. But then, so what would that sort of mean as far as the dollar is concerned, in your opinion?
It has ramifications for the dollar, equities, and fixed income markets. And the fascinating thing here, Fiona, is that since the Fed started cutting rates in September of 2024 and has cut rates 4 times for a total of 100 basis points, what we've seen is the 10-year Treasury yield moving higher, which is counterintuitive. We've also seen the 30-year mortgage rate move higher, which is also unusual. Usually when the Fed cuts rates, you get 30-year mortgage rates coming down, you get 10-year yields moving down. That's intuitive. But I think in this situation, what we're seeing is the fact that the U.S. economy is so robust that somewhat, to some extent, counters the impact that Fed cuts have had. So it's a really fascinating scenario right now. We have 10-year Treasury yields pretty high, and we have S&P 500 near record highs. So it certainly is risk on, in my opinion. And I think the dollar remains strong for the foreseeable future as a result of a few things. One, the main driver, generally speaking, there's so many different impulses to currencies, but the main driver of a currency is interest rate differentials. And the U.S. economy is growing so robustly, with inflation still sticky, that my suspicion is that the Fed maintains rates pretty high where we're at right now. Meanwhile, Bank of England is cutting. The European Central Bank is also cutting. So what happens then? It maintains the interest rate differential in favor of the U.S. dollar and treasuries. The U.S. dollar for the past year has been considered a high-yielding currency. Effectively, it is. And my suspicion is it continues to be so. So I think there's more upside in terms of the dollar, not too much upside, but it will remain strong. And then the second thing that I think is important, and with this I'll finish the answer to your question, Fiona. The second thing that's most important is nominal growth. So you have U.S. economic growth that's superior to counterparts. So you have your peers, the competition, the euro, the yen, the pound. The U.S. economy is growing at such a clip that also favors the dollar. And finally, and I think you know this, I travel quite a bit around the globe talking to our institutional clients. And what I can tell you is, after some 47 trips in the past year and a half that I've been at StoneX, investors are wholly long dollar. All they want to hear about is dollar denominated assets. And when you look at speculative positioning, it's massively overweight the dollar. The point here is that everyone's overweight the dollar assets. That could lead to some corrections in the market. But I think structurally over the course of the next year, the combination of both U.S. exceptionalism with regard to growth and interest rate differentials, combine that with the potential for tariffs, I think, in my opinion, at least, will keep for a stronger dollar. And that's to say that you would think that President Trump would prefer a weaker dollar. My suspicion is that we're going to continue to see a strong one.
I think you made a really good point, because, particularly with the currencies, it's obviously not just what's happening in the US with the US exceptionalism, with the prospect of, the Fed remaining a little bit more hawkish than potentially, or less dovish, should I say, than other central banks globally. I mean, if I look at here in Europe, particularly, we've got the ECB who are cutting rates quite dramatically in comparison to the US, and have a very stagnant outlook as far as economic growth is concerned. But interestingly, you brought up the conversation of tariffs. How significant do you think the inflationary impact of tariffs will be in 2025, given that supply chains have already adapted to a degree, I think? And do you see fiscal policy and demand overheating continuing to outweigh trade restrictions as a key inflation driver?
Those are great questions. And I do think that the inflationary impact of tariffs can be overstated. We've seen this movie before. Donald Trump came in 2018 and put on tariffs against China, and we didn't see a very marked move in inflation. It does cause ripple effects to the markets. We saw the market drop 3% the day he announced tariffs in 2018. And then later in the year, we saw the Dow drop another 600 points because of tariffs. So I would say the more direct impact is on market sentiment and on disruptions with regard to trade policy. But when you look at the numbers, it really doesn't seem to have too aggressive of an impact on inflation. I think that rather than tariffs or immigration policy, the primary inflationary driver for the U.S. economy could potentially be overheating. I mean, when you look at core PCE, which is what we look at here in the United States, we're at about 2.7%. But the majority of the pressure to the upside for inflation comes from the consumption of services. That's a very fundamental structural inflationary motor here in this country. We have a lot of people still consuming, not just consuming goods, but services as well. And then the remainder of inflation is tied to the housing market, which is still very, very robust. And we haven't seen prices come down in any meaningful manner. So I'm skeptical of the more sensationalist outlets that say that tariffs and mass deportations are going to cause a jump in inflation. I think probably you're seeing the deployment of tariffs for different reasons. Probably we're actually going to get some. We haven't quite seen that yet. But my suspicion is that the main driver of inflation is going to be far more fundamental and structural than it would be from tariffs or deportations.
Yeah, so that's really interesting what you say, because I mean, I think it comes through in the data as well. Obviously, we're seeing the jobs market in the US is really showing a resilience. We're seeing ongoing sort of resilience in the non-farm payrolls coming through. And I suppose whilst you've got a job market that's still holding up, consumer confidence is strong, and that also feeds through into sort of demand for services as well. So that's really interesting. And I guess my final question to you is, in light of the potential volatility in 2025, and how would you sort of how should institutional investors sort of position their portfolios for this expectation of ongoing economic expansion and potentially sticky inflation?
Right. Ongoing economic expansion and sticky inflation, that's really the dynamic that we're expecting this year. So what I'm telling our institutional clients, Fiona, is to maintain their overweight positions in equity markets. That's fine and well and good. Reason because is that corporate profits are at record highs or very close to record highs. So corporations are still posting really strong earnings, very good profits. So you want to maintain that, especially in the face of potential tax cuts, deregulation. Those things are very good for corporations in general, and particularly here in the United States, which is what we're talking about. So I do like maintaining overweight positions. I like equally weighted S&P 500 because in an environment where you have an economy growing above potential for the fourth consecutive year, with inflation sticky but not out of the realm of reality, we're talking like 2.5% to 3%. That's okay. I think the Fed will be okay with that. I don't think they hike with 2.5%, 3% inflation. But in that environment, you want to be playing all the sectors that underperformed last year. For example, healthcare. Healthcare is trading at a 20% discount right now, and it was the worst performer last year. So you want to be placed in the equally weighted S&P 500 rather than the market cap S&P 500, which is a third attached to the Magnificent Seven. Another way that I think that you play diversification and mitigating your downside or your volatility is with the exercising options. So you can do protective hedges, which I think is very judicious right now. That's buying put options on technology sector or the S&P 500. So I think options are a very good way to go, as well as you want to look for asset classes that have lower correlations to public markets, because something that we didn't talk about, Fiona, but I think is so important, is the fact that when you have both high inflation and relatively high interest rates, you have a positive correlation between equities and bonds. So treasury markets, counterintuitively, are no longer that hedge for your equity positions. They have a positive correlation. So everything falls, everything rises. So you want to find alternative asset classes that have a low to negative correlation. That would be fantastic. So I like gold. It's been one of my top performing calls. I think it's still has some upside for structural factors. I like, as I mentioned, defensive sectors. These are ways to protect your earnings, protect your profits. And that's what I think is the name of the game. I like a short duration treasuries. And then because this year is probably going to be a year of global growth, the place that I think we want to be looking at is in duration in high quality emerging markets. I just got back last night from Costa Rica. These are places where I think you can get additional juice, additional value in an environment that's still, from a macro perspective, positive and still good. Now, of course, the risk to this whole scenario is that inflation gets unanchored. The Fed has to hike rates, because if the Fed has to hike rates, what happens? Then the 10-year Treasury yield moves above 5%, pushes towards 5.5%. That makes the equity risk premium look pretty poor. So you get a correction in the equity markets. People move into the Treasury markets. I think that would probably be the biggest risk to my view right now. But as things stand, I think in 2025, we have a U.S. economy that grows 2.3 to 2.5%, again, above potential. I think we have inflation that settles between 2.5% and 3% this year. And I think that the equity markets continue to do well. Bottom line, protect your profits.
Thank you so much for joining us, Kathryn. It's been so insightful hearing about your macro outlook for 2025, what we should be watching and where we should be positioning ourselves. Thanks again.
My pleasure. Thank you, Fiona.